Gold sees some volatility this week, and although our next guest expects the market to benefit over the long term, he still sees more pain for the metal in the months ahead. Joining us now is CPM Group's managing partner, Jeff Christian. Jeff, always good to talk with you.
It's always good to be here.
So I know you just came back from the Denver Gold Forum where you were a keynote speaker, and you were saying that gold is still expected to struggle, but the long term, you say the fundamentals look good for the metal. Let's talk about that.
Well, yeah, we see gold struggling really for the next year or two, into early 2017 at least. Investment demand is half of what it was a couple of years ago. Supply is still increasing from mining companies with production and expansions that have been already in the works before the price fell. And we don't see any economic and political crises really bringing investors back into the market probably until 2017 or so. But beyond 2017, we expect mine production to fall, we expect investors to find reasons to invest in gold, and we expect investment demand to rise at a time when central banks also are likely to be trying to buy more gold, and mine production is going to fall. And so we think that beyond the first half of 2017, you could see gold prices accelerate sharply as those fundamentals and the economics that drive investment demand all come home.
And we'll get back to those fundamentals in a second, but shorter term, how do you see gold, especially since Yellen came out and said, look, we can still expect a rate hike this year. Do you think the Fed can do this rate hike, and what could this do to gold?
Well, the Fed can do it. We have been saying for about 18 months now that they shouldn't do it, but I think that they will do it because they're trying to salvage some scrap of credibility in the global financial markets. So I think that they can do it. I think it will have the effect of immediately pushing gold price down on a very short-term basis, like minutes or hours.
Okay.
And then the gold price would come back. And I think that what we'll see is that any interest rate increases from the Fed, if they do in fact make them, will be relatively minor and modest on the price of gold going forward.
All right, Jeff, let's talk about an issue that has resurfaced in the precious metals world regarding the alleged lack of physical gold to cover Comex contracts. Now, in a research note, you recently said that even if inventories have fallen, because they have fallen, they remain at historically high levels. Why do these allegations keep coming up?
You want to talk about the allegations, or you want to talk about the reality of the stocks?
I want to talk about both.
Okay. I think the allegations come up for two reasons. First off, there are a lot of people who don't understand the markets, and they're grasping for reasons to be bullish. And this is something that, without really understanding the data, they've been able to latch onto. That's accelerated and accentuated by people who market gold to investors, especially retail investors, trying to find reasons to put forth for them to remain bullish on gold. We saw the same allegations come out in August of 2013 by the same people. Oh my God, Comex is running out of gold. Comex gold stocks are falling. The price is going to explode to the upside. And the price has gone from roughly $1,300 to $1,100 in the subsequent 2 years. And now they're coming out with the same things. It's desperation on the part of people who are trying to sell gold to investors under any pretense.
Okay, so just going back to that point, inventories have fallen to 7 straight sessions to 6.8 million ounces. This is the smallest since October 2013, but still high, you say.
Right. Let me just follow up on one thing. I think there are really good reasons to buy gold at this level. This just isn't one.
Okay.
We're encouraging our investors to buy gold at these levels. Inventories have fallen. They have fallen. You can look at different parameters. The amount of gold inventories relative to open interest. You can look at the amount of gold inventories relative to deliveries. And you can look at the amount of deliveries relative to open interest. All three of those parameters factor into whether or not a decline in actual volumes of ounces registered and eligible with the Comex are important. And if you look at them, and let's look at inventories, total inventories relative to open interest, they have fallen, but they've fallen to levels that roughly represent the highs of that ratio from 1975 through 2006.
Okay.
So what we've seen is after 2005, 2006, with this rush of investors into gold, we had a tremendous surge in open interest. We had a tremendous surge in stocks being registered and brought into New York vaults. So the eligible stuff, which is not registered, also increased sharply. And we saw the inventories relative to open interest rise very sharply into about 2011. Then open interest and stocks both started falling, but that ratio has fallen back to what really represents the high for most of Comex's gold futures existence from 1975 to 2005.
Thank you for clarifying that, Jeff. Let's just end with the fundamentals for gold. If you had to pick one main driver for gold in the next 5 years, what would you be focusing on?
I would be focusing on investment demand. As I said, it has fallen in half over the last several years, and we expect it to remain around the current levels, around 20 million ounces a year of physical gold for a year or two. But at some point, we think that the economic and political environment will worsen in a way that will cause investors to step up their gold demand. That probably will come at a time of increased central bank purchases and declining gold mine production beyond 2018 or beyond 2017. We expect mine production to grow into 2017 and then start falling. And so we think that when investors start stepping up their gold purchases, they're going to find a market where the supply of newly refined gold from mines is coming off sharply, and central banks are already there buying more gold, and there'll be a competition for scarce resources starting in 2018.
Jeff Christian, thank you so much for speaking with us today. I appreciate you stopping by.
All right.
And thank you for watching this edition of Kitco's Gold Report. We have Gary Wagner up next. Stay tuned.